Ladies and gentlemen, good day and welcome to Q2 FY24 earnings conference call of Bikaji Foods International Limited, hosted by Essential Technologies Private Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Vijay Gyanchandani from Essential Technologies Private Limited. Thank you, and over to you.
Thank you. Welcome to Bikaji Foods International Q2 FY24 earnings conference call. From the management, we have Mr. Rishabh Jain, CFO, and Mr. Manoj Verma, CEO. Now, I request Mr. Rishabh Jain to take us through the key opening remarks. After that, we can open up the floor for the Q&A session. Thank you, and over to you, sir.
Thank you, Vijay. Thank you very much to all the investors who joined the call. Our presentation has been uploaded on our website and on our BSE exchange. We are excited to share our Q2 results. So we are seeing some tough challenges and slowdown in from first quarter. But overall, from our Bikaji standpoint, so we have seen a good numbers from sales and volume perspective. So in Q2, we delivered a 5.5% growth over last year September quarter. But overall, if you see a category snackshary point, so overall from volume perspective, our volume and snackshary segment is upward of 17%, which is highest in last many years. Our EBITDA growth is close to 36% compared to last quarter, and overall 14.4%, which is highest in last many quarters. This is the first year where we crossed 1,000 crore top line in first 6 months. This is the first year where we have crossed 100 crore PAT in first 6 months. This is the first year where we have crossed 1,000 crore net worth. So this is a very special year for us. Overall, from PAT perspective, we crossed 100 crore PAT in first 6 months. And this quarter, our PAT was close to 9.8%. Our gross margin is stable at 33%, which was same largely in first quarter. From H1 standpoint, so our overall volume and revenue growth is close to 9.5%. Our EBITDA growth is 61%, close to 154 crore rupees. And overall, our gross margin is stable at 33%. From snapshot perspective, overall, we have delivered the highest volume growth of 17% in salty snacks category. Sweets, of course, is a little bit shift from Diwali perspective, because last year Diwali was in October versus this year Diwali is in November. So there is shift in sweets and gifting stock. But our salty snacks business is doing reasonably good job. We invested a lot in consumers. So basically, from our key products like Bhujia Namkeen, we started consumer offer of giving 10% extra in our key consumer pack of 400 and 200 grams. Our family pack contribution is close to 57.6%. Overall, from distribution standpoint, we have added 46,000 outlets in Q2, and Manoj will discuss in detail in coming slides. We also worked in a strong RTM plan in Rajasthan and UP. We have added few depots in a core market and focus market like in Varanasi, Ghaziabad, Ahmedabad, and Pune. From ROC and ROE perspective, so our ROE has increased to 20% in this quarter at annualized basis, and ROC 27%. Overall, we have recorded highest ever EBITDA of 14.4%, and we have started business expansion. Like we have started one subsidiary in USA in last quarter, and we acquired a small company named Bikaji.
I'm sorry to interrupt. So this is the operator here. So can you come closer to the microphone, please? The voice is not coming very clear.
Yeah. So from product category perspective, we are largely into 5 key categories. One is Bhujia, which is close to 33% of contribution. Namkeen, which is close to 37% of contribution. Packaged sweet is close to 12 to 15% of contribution, depending on season to season. Papad is close to 4% of contribution. Western snacks close to 7% of contribution. Gifting is a key in Diwali season. So basically, last year Diwali was in October, so major gifting was done in September month. Second quarter this year Diwali is in November. So major gift stock offtake will be done in first quarter. Overall, from capacity standpoint, so our overall capacity stands at close to 2.8 lakh metric ton. Our two plants, one is frozen and the other one is Raipur CMU. So frozen will start in mostly this month. So in next 40-45 days, we'll start frozen plant, which will be key for export market. And our Raipur CMU is on target, and we will be starting in before March 24. Overall, from PLI perspective also, we have committed close to 430 crore rupees of investment, and we are on track to deliver to commit this number and to invest the same capex within the same time, given timeline. From here on, Manojji, I request you to take the.
Thanks, Rishabh. Talking about distribution, if we look at, last year we added about 100,000 outlets, and what we called out for ourselves was that direct reach, we'll take it to 250,000 outlets. So as we exit this quarter 2, we have added about 46,000 outlets in this quarter, and the number has moved up to 208,000 outlets as our direct reach. Now, in endeavor to set this distribution model strong, what we also did was that in this last quarter, we added 4 depots. These are at Ahmedabad, Pune, and 2 in UP, which is Banaras, Varanasi, and Ghaziabad. What we also did was that there's a shift that these UP CFAs, what we added, are the professional, hardcore professionals who are CFAs for Britannia. In that line is the expansion what we have done. This quarter has been, a little high on our media spends, ad spends. We were there on air, we were there on radio, we were there on print media, while gifting was at front, but we also shot few ads with Amitabh Bachchan in this quarter, and which are now up on air. So that's the investment what we made behind media. For the first time, we went very aggressive in terms of consumer offer. This was both with respect to reward our loyal customers and also to recruit few customers, keeping in view the competitive pressures as well. So even on our core products or the flagship product like Bikaneri Bhujia is what we gave now as consumer offers to the tune of 10% on certain SKUs. Talking on the financials, if we look at, so Q2 volume growth is, overall volume growth is 5.1%. If we look at revenue growth is 5.5%. Ethnic snacks revenue growth is I think Rishabh has just touched upon. It's nothing but a shift from 1 month or 1 quarter to another quarter. So that's at a 12.6% degrowth. No, it appears to be on this stuff. So overall, if we look at it at H1 level, so our volume growth is 10.5%, revenue growth is 9.5%, ethnic snacks at 12.7%. Again, if we look at overall as our volume growth on ethnic and western snacks is about 17.5%. Packaged sweets at -7.8%. Western has already clubbed with Snacksony, and Papad is at -2.2% growth. Product mix, if you look at what happens is that in Q2, there is a strong play of sweets, and hence the contribution of sweets becomes higher. However, if we compare over last year Q2, so last year Q2, if we look at sweets contribution to overall business was 20.7, which this quarter was 17.1. And again, this is a repeated statement of shift of Diwali from October to November. Hence, this play. Rest overall, if we look at are by and large in line with what we were there last year. Now coming on in terms of how we look at our business is core, focus, and other markets. So quarter 2, if we look at our core market has delivered a growth of 6.3%. Focus markets, as we have been saying that will be a high index on growth, is at 11.2%. Others is at 5.3% growth. Exports at 0.5. I would wish to clarify on when we say others is at minus 5.3% growth is primarily on account of sweets and gifting. The sweets in itself contribute to about 40% of business in other states, because that's where we ride on the modern trade channel. And this quarter, if we look at, when you look at channel-wise growth, so modern trade is one which has brought it down, and that is not actually a degrowth. There's only the shift from quarter 2 to quarter 3. H1 story, if we look at, so core states are at 10% growth, focus states at 13.5% growth, others at 1.1%, and exports is close to 11% growth. Focus market contribution, so if we look at now, is 71% comes from focus from core markets, 14 from focus, 10.9 from others, and exports contribute to 4% to our overall business. Region-wise, now if we look at, so East at 1.3% growth, North 9.6% growth, South market, where we have 2 focus markets, which is Telangana and Karnataka, has delivered a 13.4% growth, and West is at 8.4% growth. And in fact, most of our states falls in others, which are from West. So H1, if we look at East, stands at 6.8% growth, North at 12.2% growth, South at 24.3% growth, and West negative 3.7% growth. In this quarter, we look at impulse pack, so which is 5 and 10 rupees pack, has delivered close to 12% growth. However, family pack are at 1.3% growth. Here the growth looks low on family pack, again is on account of, because there's most of the entire sweets falls in family pack stuff, and that's at a negative 12.6% growth. So that's the factor. Rest are at 8.2% growth. At our H1 level, if we look at our impulse packs are at 11.3% growth, and this is a testimony of that how our expansion initiatives are working, because small packs takes our distribution up. Family pack at 8.4% and others at 13.2% growth.
Yeah. So from overall revenue perspective, so our overall revenue has reached to close to 609 crore rupees in this quarter, and overall it's close to 1,090 crore rupees. If you compare to first quarter, we've grown at 26% compared to first quarter. And from EBITDA perspective, our EBITDA growth is close to 33% compared to first quarter. So our EBITDA is close to 88 crore rupees and PAT is close to 60 crore rupees. So we have worked on multiple efficiency program across all, be it logistics, be it manufacturing costs, and we have saved a few percentage point across each level, and that has improved our overall EBITDA level. Overall, from the RM perspective, so basically our few edible oil, be it few purchase, so all has been supported and cooled off in last 2 quarters. That has supported our margin. So we started our IPO journey in June last year, where our gross margin was close to 24% and has been increased 33% in last 6 quarters. Our EBITDA has been close to 7.5%, has been increased to close to 14.4% in last 6 quarters. So we are working a way that overall cost efficiency and EBITDA improvement. That's a core KPI of all our key functions. From financial standpoint, we have first time touched 1,000 crore net worth Number two, so in second quarter, our inventory and debtors are little bit on high side. It's regular. If you see our last year September quarter also, that's on the same line because we need to have inventory level at a big level because Diwali season is very nearby. So when we'll see a December quarter again, it will reach to optimum level. And same with the debtors because we need to supply to a few modern trade stores, and they normally do 25 to 30 days credit period. So that normally we'll see in this December quarter, it will become at optimum level. That's from the presentation standpoint. We are happy to answer all the questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have our first question from the line of Abneesh Roy from Nuvama Institutional Equities. Please go ahead.
Yeah, thanks. Congrats on margins. My first question is on Western snacks. So you are given the 2025 vision. My question here is, this is a tough business given there is a large multinational player and there are a few Indian players also who are very strong. Here the issue is logistics cost is very high given the thing which is transported is air. That's the big thing inside the packs. So that makes it very, very tough and very, very important to have very regional kind of manufacturing in every state, every key demand center. So here, once you scale this up, how do you see profitability in this part of the business, and what's the current profitability, and what is the right to win here? Because you are seen as a Indian snacks, why you want to scale it up to a bigger business? Because already intense players are there in this business.
Yeah, Abneesh, I think what you said is absolutely right. That you cannot transport Western snacks beyond certain kilometers because it starts giving diminishing return. And this perhaps was the reason that till about 2 years back, we were only doing Western snacks in Rajasthan or close by area. That also to a limited volumes. What we felt was that Western snacks category is larger, is much bigger than what Indian ethnic snacks are. So the choice what we had is either leave that space vacant, or we do not go aggressive on that stuff, yet have our presence. By virtue of our expansion across country, and all our factories which has come up in last 2 years across geographies and zones of the country, we have built our capacity to produce Western snacks and along with our ethnic snacks. So that's the strategic investment what we made, and we will ensure, and we are doing that these Western snacks would be supplied in the nearby areas only. That's one. Second thing is that the perception what is there, and is true to certain extent, that Western snacks are not as much profitable, is by virtue of one point you said that this eats into a lot of space and hence cost not cost effective on logistics. Second, Western snacks is primarily a 5 and 10 rupee category, and these small pack have relatively lower gross margins, so therefore it gets hit from both sides. So therefore companies high on Western snacks or majorly on Western snacks would be struggling to deliver the EBITDA level what other companies or the companies who has high contribution of family pack or ethnic snacks. So that's the reason, and this is what we are doing about it. So this is not eroding our overall margins, which we are conscious of.
So 2 quick follow-up. One is you had a 32% gross margin this quarter. Will it be fair to say that Western snacks will be more in the 20s in terms of gross margin? And second is, which are the key states you are targeting for this, or is it most of your key states currently?
So basically, if you compare to overall ethnic snacks category, of course, the gross margin is around 26 to 28%. That's what the gross margin in salty snacks category. And from state perspective, so basically, so we came up with plant in Assam, Bihar. So in last 2 years, all the core market, as well as in focus market, a plant has came in UP and in southern market. So we are trying to cater to the state where we came up with plant. That's what our strategy is.
Sure. My second and last question is why ad spends went up given festival demand is essentially going to come in Q3. Your sales also was slow. So is there any linkage with the slower growth? Because all FMCG companies are saying slowdown is definitely impacting in Q2. So if you could elaborate on the ad spends and where do you see in the second half in terms of the number? Second is, could you quantify what is your view on the festival impact? So versus a 5-6% growth in Q2, where do you see Q3? Not a guidance, but generally understanding how the festival impact in your businesses.
So I echo with what you said, and that's what is the sense we get to see and hear, that the momentum what it was there in Q1 was not as much in Q2, and I think whatever results are being published or in public domain speaks loud about it. For us, if you talk about while we say that it's a 5.5% growth, I think it will not be it's not an apple-to-apple comparison, because in our categories or the set of categories, sweets play a very critical role, and this is what we happen to speak and touch upon in our last calls as well. That there's a deferred Diwali this time. So last year it was in October, this year it's in November. Diwali sales, if you look at starts N-45 days is the time when we start loading. So therefore, if you look at in Q2 our fractionary growth, so volume growth is about 17.5%, which is ever highest volume growth. So I think it will not be fair to say that it has not been a good quarter for that stuff. It is only on account of sweets, which is at negative 12.6, and you will see a complete turnaround in Q3. To your question, how do we look at Q3? Now, sorry for we will not be able to give you any guidance on that stuff. However, we can certainly speak about that the 1 month or 1.5 months, which has just passed by or about to be, it's well on track. There's quite a momentum, positivity in the market space. Our categories, which are dependent on Diwali, say, which is sweets and gifting, has done very well for us thus far.
So one small follow-up, if Diwali impact or festival impact would not have been there, fair to say that the sweets growth would also have been in positive territory, and broadly in the growth of, say, ethnic snacks? Could that have been a possibility?
100% yes.
So thanks. That's all for me. Thank you.
Thank you. We have our next question from the line of Gaurav Jogani from Axis Capital. Please go ahead.
Thank you for the opportunity, sir, and congrats on the good margins. So my first question is with regards to the clarification. The audio was not clear. You said the ethnic snacks margin are 26 to 28%, and what are the margins for the Western snacks?
No, so Gaurav, ethnic snacks margin, so I told you Western snacks margin is between the range of 26 to 28%. That's what I told compared to ethnic snacks. So ethnic snacks have higher margin compared to Western. Yeah.
So you said, sorry, full packs are 26 to 28% margin.
Western snacks,
Western snacks 28 to 26 to 28. Oh, so okay. Yeah. And sir, my next question is with regards to the distribution expansion you have taken. And you have also mentioned that now you are moving from a model of sub-stockist to a direct reach. So if you can explain some bit on how this is going to positively have an impact on our margins, what is the time to transition to this, and the 4 depots that you have opened. So something on that front, if you can explain in a bit detail.
Yeah, sure. So I think FMCG is about distribution only, and it's a never-ending story. So year on year, you will happen to hear from FMCG players that the target is to increase direct reach, right? How it helps is that when you cover any outlet directly, your ability to sell what you want exists. Whereas, if it's through a wholesale model or it's through just, indirect distribution, then, your products would move which all are pull SKUs. And for any company, they're not 100% products which are pull products. There's always a tail, which you have to push it. So that's the reason, that direct coverage is important for FMCG business to have fundamentals and forward building right. Talking on this CFA model, it's not about not to have sub-distributor. it's about reducing our dependence from direct dispatches, which we were doing it or we still are doing it from our Bikaner factory. So this becomes mother depots, and this would help us improve our fill rates, fast service, to the distributors in that respective area. Eventually, what we'll do is that this will bring in some saving, wherein we can weed off certain super stockists. However, this does not mean that super stockist model will not exist. But super stockist thereafter will be for smaller towns, rural penetration and all.
Sure. So if I understand it right, under this new CFA model, earlier you were doing direct dispatches from your factory. Now, under this, you will now be giving it to the CFA agent, and then the CFA agent will then be giving it out further to the distribution chain. Is that understanding right?
Absolutely right. So I'll just illustrate this with some example. Say, let's say, and I'm just putting some hypothetical stuff. Say, let's say, there's a distributor in, say, Ghaziabad, Agra, I'm talking, say, Western UP for now, right? So from factory, full truckload goes, which is, say, costing about 15 lakh. Now, if he does not need 15 lakh of stocks and he's running out of, say, a few products, then, either he's, getting overstocked for products he don't need, so that again is not good for us and for him, or he's, running out of those stocks. So now this mother depot will help us, even part shipments, small shipments are to go. It can easily be transported quickly.
Got it, sir, got it. And sir, when we are shifting from this CFA model, from the sub-stockist models, is there any part of change in the margins for the sub-stockist or for you? And how does it create more efficiencies in terms of margins?
So nothing changes for front-end set of people, be it retailer, be it distributor or sub-distributor or super stockist, right? What helps us do better is that, eventually we'll weed off few, say, let's say, for any urban town or a large town. Currently, it is getting routed through super stockists, wherein we are parting 3 to 5%. These towns will then be direct distributors. And that's the saving which will come back to us and fund for whatever we are spending on the CFA stuff. Also, I would want to, table it that CFA, what we are doing is nothing new or, out of the box. I mean, that's the industry practice and companies have been doing it for many decades now.
Sure, got it. And so my second question is with regards to, the margins that you're seeing, the gross margins expansion. There is definitely an element of the correction in the RM prices, especially the edible oil thing. But, now with the edible oil prices bottoming out, how do you see the model going ahead? And then how do we see the margins in the future quarters, given, you're also passing on some prices to the consumers?
Yeah, Gaurav. So basically, from gross margin perspective, in the last 2 quarters, the gross margin is stable at 33%. So we want to be about 32%. That's what is our internal target, and we'll be passing on the prices once it increases. But looking at next 2 quarters at least, we are not seeing any increasing in price in edible oil. It's largely looking stable. From key commodity perspective, of course, we are looking some upward in few commodity, but it will be largely on track, and we'll be not seeing any major variation in key commodity in gross margin.
Okay. And so just last one bookkeeping question. The tax rate for the quarter is a bit lower at around 20% odd. So what is this because of, and how are we looking to, what would be the tax rate guidance for the entire FY24?
So tax guidance will always 25%. So tax for us will be 25%. But yeah, this year there is some ESOP vesting, right? So there is deferred tax accounting which has just been done, and so that's why it's looking at 23%. But yeah, our tax rate will be 25% from next year.
So what would be the tax rate guidance for 24 in that case?
24 will be close to 23 and a half, 23%.
23 to 23.5%. Okay. Thank you, and that's all.
Thank you.
Thank you. A reminder to participants to press star and 1 to ask a question. We have a next question from the line of Percy Pantaki from IIFL. Please go ahead.
Hi, sir. On your ethnic snacks, your volume growth is 17%, your value growth is 10%. So just wanted to understand such a huge gap between volume value. What is the reason, and will this continue for the next few quarters as well?
So Percy, basically we started consumer pack in last quarter, right? So in key commodities like bhujia number 1, which is contributing close to 33% overall top line. And so in 2 SKU, which is 400 and 200 gram, we have started consumer packing. If you key namkeens, like which is a big in our overall namkeen segment. So we have started consumer pack. So that's why your volume has picked and value looking at downward 5-6% gap is there. But yeah, overall that's the opportunity for us that if any point of time if prices of raw material increases, it's easy for us to withdraw consumer pack and again regain our margin. That's what we want to do.
So if I just understand correctly, what you're saying is that you have launched smaller pack sizes, and the rupees per kilo of the smaller pack sizes is lower than the larger pack, and that is what is causing this. Am I right in understanding that?
No. So basically, I'll give you an example. Like we have launched previously, we have 400 gram. Now we have launched 440 gram, 10% extra in consumer pack. Same with the 200 gram case.
Okay. So extra volume. Okay.
Yeah.
And this is mainly to pass on the input cost benefit, or is there some other reason?
So for two perspectives, to increase the loyal customers, because ultimately we want to gain new customers and ensure that our existing customers gain from us. Number one, and number two, of course, to looking at competition. We want to because in bhujia we are leader in this segment. We want to increase the consumption, and that's what our target is.
Okay, but given that your margins have not been affected, I am assuming that whatever you have passed on, you have gained the similar amount in input cost deflation, right?
Yes. So in last 2 quarters, we've seen reasonable cool off in edible oil prices, which is supported, and there's few efficiency program which we have ran, and it's given a good result for us.
Understood. And this volume value gap of 6-7% will continue for next 3 quarters till it anniversarizes?
So, firstly, we cannot say much, but yeah. So largely, if any key commodity, if we see a rise in any key commodity, so of course we'll withdraw that offer. But yeah, at least for next 2 quarters, there will not be much difference.
So assuming that input cost stays where it is, then the pricing will also stay, and this gap will continue for 3 more quarters till it anniversarizes. Is that correct?
Yeah.
Okay, understood. Second question is on sweets. We understand the seasonality impact of Q2, Q3, the festive season changing, etc. But apart from sweets, in the snacks business itself, is there any such seasonality impact?
So there is little bit seasonality impact because during Diwali season, bigger pack sales come. It's little speed up compared to the impulse pack. So this quarter, bigger family pack sales will be much higher in this quarter. So, but yeah, there will be not much variation in salty snack segment. Largely sweets and papad, these 2 categories, little bit of seasonal impact. But salty snacks is largely in line with across if it's 12. There is not much difference.
Okay. So, sir, the reason I'm asking this is, see, if I basically remove the sweets impact, so let's say instead of degrowing 12%, let us say hypothetically, if the sweets had also grown by around 10%, this quarter, then your overall sales growth would still have been around 9% only for this quarter. So that is still much below what we are targeting, which is a mid-teens kind of a number, right?
No, so see, if you look at the net of 2 categories, which is bringing it down this overall number. One, of course, is sweets, which, as we explained, is on account of Diwali. Second is, which is also a large player, is we call it as our other stuff. This is our gifting business, which is huge. We do about 25 crores of gifting as well between these quarters. So these 2 are purely on account of Diwali. What has not done as well is the papad category as well. I'm sure you would have seen in our presentation what we have uploaded. The reason for papad poor performance has been early monsoons and then extended monsoons. Ours are handmade papads, and you don't get the papad dried up, and therefore supply becomes a huge issue. We cannot meet demand. So that's what has been the reason that for these low performance on these categories. Other than that, if you look at Rest all categories, the volume guidance what we gave would be in tune of about 15-17%. This is well on track for what we said.
Understood. And last question, if I may be permitted, in a situation where input costs are stable, what kind of EBITDA margin would you target, let's say, 3 years down the line? You have already reached around 14.5%. You are getting some PLI benefit which has aided. Also, maybe some point of time, some part of this PLI benefit gets passed on because of competition, etc. So do you think there is still sort of drivers to take the margin up from this level over a 3-year horizon, or do you think that you would be satisfied with this level of margin?
No, so basically, we want to work on 2 things. Basically, of course, top line growth is paramount for us. It's important because currently our 70% sales come from 3 states. It's a big opportunity for us when we look at all the other states, and we are in a very limited way. So it's a big opportunity. We want to target the growth also. But yeah, overall, from the bottom line perspective, basically, you see currently we are using close to 40 to 50% capacity utilization, and 1-2 more plants is coming up in next 3-4 months. So of course there is a fixed cost which is sitting in our books, so once we start utilizing this capacity at 70-80%, there will be operational efficiency which will start building, and we want to be at plus. So from this we want to save at least 0.5 to 0.75 basis point from using capacity utilization, operational efficiency. That's our target is. And from next 3 year basically our revenue will also increase, our purchasing efficiency will increase. So of course we want to build close to 0.5% EBITDA improvement year on year. That's what our internal target is.
Okay, understood. So 50 basis points is the final flow through in the P&L after reinvesting whatever you want into the growth, etc.
That's our internal target. Depends.
Understood.
Anything competition, but yeah, that's a
Sure. Very helpful. That's all from me. Thanks and all the best.
Before we take the next question, we'd like to remind participants to press star and 1 to ask a question. We'll take our next question from the line of Shirish Pardeshi from Centrum Broking. Please go ahead.
Hi Manoj, Rishabh sir, good afternoon.
Good afternoon, Shirish.
Yeah, a couple of questions. The history tells that whenever there is a benign raw material, especially the commodity, like of wheat flour, pulses, and edible oil which is falling, we see a lot of mushrooming of local competition. So could you spend a minute or 2, because when I look at the regional performance, I was expecting that Western should recover, but Western has declined almost 8.4%, while South, which is not a high snacking market, has shown a growth of 13.4%. Obviously there will be some distribution benefits you would have gained. But could you talk something about, is there competition angle is also holding the snacking, because some of the snacking companies are highlighting the local competition is beating them, or regional competition is also mushroomed very quickly?
I think you're absolutely right, and the feedback what we get to see and hear is very, very true. During COVID times, what happened was that these regional and local players got very badly impacted, and there's a lot of shut shops kind of a thing which happened. Then up till beginning of last year Q1, wherein the inflation was at the peak, these companies could not survive. However, if you look at the last 4 quarters, things are now picking up, and that's where is the kind of pressure from local and regional players is there. But not to the tune of how it looks like or how it would impact us as adversely, because it's a huge category, and we even today are a very, very small player in terms of the opportunity what we see for ourselves. And this I'm talking more with respect to the South market, you said, wherein growth is high, but we hardly ever share in those markets.
Okay. Similar, could you spend some time explaining what is it that export, because export has stagnated around 24-25 crore in this quarter. So is there any growth lever which we can expect in second half, or is there any specific on ground changes you guys are doing, or how should we look at the growth for international?
I think, see, Shirish, we have been talking in the past as well that exports we see is a huge growth opportunity, right? We have been investing, so we are on to it. What has been holding thus far is our capacity to supply what exports market need, and this is the frozen part. If we look at about 40% of our exports business is depends on our frozen products, and which we were not even today we don't manufacture ourselves. We get it outsourced, and we were always constrained on supplies when the demand and all that stuff comes in. Come December, which is next month, is what our frozen factory getting commissioned, and that will unleash our exports opportunity. It will not be fair to say next 6 months, but I think the right time frame would be next 4 quarters or next 1 year. You'll see a substantial difference, or a growth driver this exports market will be for us. In this journey, what we did in this last quarter, and Rishabh spoke about in the spiel as well, is that we have opened our office in US, which is where the highest Indian diaspora or these consumers stay. So as to get best out of it, we thought of having our office, and this will help us do much better in these markets. But I think it will take some time, Shirish, as we said, that we have to be ready with back-end supplies to support demand and be competitive in these markets.
That's helpful, Manoj. My second and last question on the gifting pack, though you have given some number, I'm specifically asking during the festive season starting from Durga Puja in the Calcutta or maybe Diwali across the nation, what that 45 period brings the contribution for the gifting part of the business? Will it be substantially 50% or will it be lower than 50%? Because you've spoken a lot about it.
Shirish, can you be what percentage? Say again.
I'm saying that gifting part of the business which picks up, especially for the sweets during the festive season.
Okay.
So in that 45 days period, what kind of quantum, in terms of quantitatively, if you can say that, what contribution comes from gifting part of the business?
So, I see, these Diwali gifting or what we say seasonality. So this is 2 elements. One is sweets. So sweets in itself, which is say son papri, rasgulla, gulab jamun, then kaju, so some premium stuff. So that's one sweet. And the second is gifting. This is nothing but gift boxes which contains a set of different products inside it, what we call gifting, and we have various designs, different price points, in the tune of about 10 to 11 numbers. Now, if your question is that what is the contribution of just gifting boxes to overall gifting sweets and this put together, it's 25%.
Okay. So you are indexing sweet as 100 and of that 25% is gifting.
Yeah. So I'm talking incremental. Otherwise, sweets is round the year business. Gifting is only in this period of Diwali and Dussehra. Okay. And for full year, with the year which has gone by, what would be the gifting part of the business for FY23? 1%. 1%. Yeah. So as I said, it's about 25 crores. Okay. So almost 1%. All right. So that means this year you are expecting a very strong growth, and that's what Rishabh was alluding, saying that now you have an inventory in your control, so that can expect a higher momentum in Q3. No, inventory, sorry, Shirish, I couldn't connect this with inventory. No, Rishabh in the beginning said that because of the Diwali festival, our inventory levels has gone up. So I would assume that we have enough inventory to cater this festive season. Yeah, of course. That's the mindful and thoughtful inventory build-up. So as to cater, these, because what happens is that all demand comes up just, N-15. That's when a retailer wants to get stocks on his shelf. Even there's a stock constraints at distributor place also. Irrespective of during Diwali, they hire additional space and additional depots for them. But the offtake or velocity of sales is, Shirish, so high that they cannot hold these stocks, and that's why we have to build it at our factory, at our depots and all. Wonderful. I hope you will break the records historically. Thanks, Shirish. All the best.
Thank you. We have our next question from the line of Percy Pantaki from IIFL. Please go ahead.
Hi, sir. If you can just give some more granularity on your focus markets in terms of which are the within the six, what is the Pareto like? I'm sure 2 or 3 of them will probably account for a very large part of your sales. What is the market share in those geographies? And overall, out of your 2.5 lakh direct distribution, what is the split between focus states and core states, and how do you plan to grow it ahead? And finally, culmination of all this, focus states growth rate would be what percentage, what basis points higher than the core states in your view? So sorry, many parts to this question, but just this one question.
No, thanks for this question, and I think it's very important question, and it's part of our core strategy as well. Because beyond the point, growing in our core states, where we enjoy in mid-40s kind of a market share, will be difficult to hold and take it beyond. So hence is the major role of focus market. What we've identified focus markets for ourselves are 4 from North India, 2 from South India, and these 6 markets in itself is about 41% of category business. So that's where is the area where to play we have identified for ourselves. To your question, that which are the Pareto states amongst these focus states if we look at. So UP in itself is big enough. So UP versus we put all together is almost the same number. So that's the kind of opportunity. And with this opportunity comes a lot of complexities as well, because there are monster brands sitting which we have to take head on. Our inroads thus far has been very encouraging, promising. We were able to get into these markets in terms of our expansion, what we have done. To your question, you are asking that the coverage, how's that we are looking at it. See, in core markets, our brand is very strong, so hence there's a huge wholesale pull as well. So our direct reach does not matter as much, though it is icing on the cake, but it is not dependent only on the direct reach. However, when we speak about focus states, there the brand recall is not as much. So therefore, it is only when our salesmen visit the store, he talk about the Bikaji story, talk about something with Amitabh Bachchan ads and all. So that's a reminder, that's what recalls create the brand recall and able to make a successful or a productive call to place our products. So therefore, our efforts on increasing direct reach in focus state is by far high. Quantifying on numbers, if we look at, so we have reached by end of this last quarter 208,000 outlets, of which 107,000 outlets are in focus states that we are covering. Hope I answered this question on the coverage reach you were talking on.
Yes, very helpful, sir. And in terms of your target.
Sorry. So in terms of growth target, these focus states will be at 1.5 index to 1.4 to 1.5 index growth to core states.
Understood. That's very helpful. Yeah, that's all from my side.
Thank you.
Thank you. Ladies and gentlemen, to ask a question, please press star and 1 on your phone now. As there are no further questions, I would now like to hand the conference over to management for closing comments. Over to you, sir.
With this, thank you so much, the investors. You took out time for this call. Hope we were able to answer the questions and our presentation was good enough to give clarity. Our endeavor has been to keep it very transparent, get it as much details what we can. We've tried to do. Howsoever, if you feel any question has left unanswered or you could not ask in this call, please feel free to reach out to our team and we'll be happy to revert back. With this, wishing you all and your families a very happy Diwali. Thank you very much.
Thank you, sir. On behalf of Essential Technologies Private Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.